there have been rate of change declines before, like in self-storage, circa, call it, 2011 to 2015 or 16. There was kind of the spike post GFC in same-store NOI growth, and then a gradual kind of decline in the rate of change sequentially, but nothing like really sharp until 2016 when the development cycle kicked up and like all of these guys were kind of kneecapped in how aggressive they can get on pricing. And I think the debate right now in some of these property sectors is does that rate of change kind of look like a gradual slope down to a normal rate up, from these lofty levels that we've seen, or are we looking at a cliff? And I guess what I would say, the way I read it, and this is the debate in the REIT sector right now, is which sectors are going to see that cliff. And like in a normal world, if I'm just going to throw this out there, if CubeSmart was to grow FFO 8% year over year in the third quarter, that'd be like an awesome year. But the problem is they're going from +20 to +9. So like that is what's people are trying to wrap their heads around. And I guess why, from where I sit, I think it makes more sense to stay long the coastal apartments, which are a couple quarters lagging behind in that rate of change, versus storage, which by the way is killing it. They're doing great, but they can't, to your point, comp from last year, and so there's a cliff kind of from +20 to +9 or somewhere around there.
It's a lot easier when you just tie it to the stock. I mean, what were the stocks expecting a year ago? That we're going to see the best property price inflation metrics in U.S. history, or at least of the modern era. And now what are the stocks discounting? That you're going to have to compare against that. It's everyone wants everything to go up, but the fact of the matter is that it goes down when it went up too much. So, and that's how you risk manage. I mean, most people don't, first of all, most people didn't even know that inflation was going to double and double. So, it's like the Fed, they're on the wrong side after being on the wrong side, because they're always on the wrong side. And then by the time we get to the fourth quarter, things like property prices, I mean, anything tied to where we were in the fourth quarter is going to go down if everything doesn't go down. That's the point. If prices don't go down from here against the base effects, they're going to go down. And not everybody understands that. And that's fine. That's a huge competitive edge that not only we have, I mean, there are other people obviously that do rate of change.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.